Hey guys, how are y'all doing? For today's lesson, we're going to be talking about the PE ratio or the price to earnings ratio. And this indicator for a company's health is arguably one of the most important and most used by all investors and analysts because it relates the price to the earnings per share of a company. But we'll get into that later in the video. So let's go. So what is the price to earnings ratio? The price to earnings ratio is just the a comparison between the current price of one share of stock for a company to the earnings that the company is making. So the profits that the company is making, the earnings per share though, earnings per share. So as you can see in this graphic, for two companies with the same price, a high EPS, which is a high earnings per share, means that they will have a low price to earnings ratio, while a company with the same share price with a lower earnings per share will have a high PE. And so basically why this indicator is so important, as you can see here, is because it kind of validates the price of a stock, whether or not this stock is overvalued or undervalued based on the actual fundamentals and actual results of the company. Is this company making the money that it claims, and does the price of a current share of stock justify that? Is the company being valued at the right price for how much, I guess, income it's generating for its investors? That's why this indicator is so important. So now we're going to go into how we calculate the PE ratio, and it's pretty simple, as you can see here. It is just the market value of one share of stock over the earnings per share. And as I've stated in my previous video about the earnings per share, there are many different types of earnings per share. And so many of these can be used for their own sort of variation of the PE ratio, which I'll get into later into this video. But for now, just want you to know that the basic formula for the PE ratio is just the market value per share over the earnings per share of that company. The money that it's generating divided by the total number of shares that the company has. And so, like I said, we're going to be getting into four different types of PE ratio today. So we have the forward price to earnings ratio and the trailing price to earnings ratio, and those two kind of go together. And then you have the absolute price to earnings ratio and the relative price to earnings ratio, and those two are kind of variations of themselves, as you can of themselves basically. So first, I'm going to be talking about the forward price to earnings ratio. So you can see here that the forward price to earnings ratio formula is a little bit different from the basic price to earnings ratio, formula that you saw earlier in this video. Instead of being over just the earnings per share, it is over the forecasted earnings per share over the next 12 months. And in my video about earnings per share, which I highly recommend that you watch, I talk about how earnings per share can be estimated by analysts. And this is basically what this price to earnings ratio uses. The forward price to earnings ratio uses estimates that analysts have given out to the public for the next 4 quarters of a company's earnings. And so that's basically what this forward price to earnings ratio uses. And this is contrasted with, as you could probably tell, the trailing price to earnings ratio. And so this is a little different because instead of using analyst estimates for shares, it uses what the company has already given out in its previous 12 months of earnings. So it's past 4 quarters of earnings. And so basically, why there are these two different types of PE ratios is that some people prefer to look at a company's history and its past trends and how much money it's made in the past to determine its future, while others may want to rely more on analysts and their own work and what the analysts have come up with. And these analysts, they also look at company fundamentals, they also look at past trends, and they use that to determine the future earnings per share estimates. So both of them are trying to kind of predict where the company will be going and the future value of the company, but it's just two different ways of doing the same thing. And so you can see here, this is an example of how we calculate the trailing price to earnings ratio. So say for example, there's a company. Uh, it's worth right now. Its shares, one share is worth $100. And so in the 12 months before, they've made $20 billion in profits, and they've have currently 5 billion shares outstanding. So there are 5 billion shares out there in the market for people, for investors and traders to buy. So the EPS is just calculated by dividing the profits, the income, by the shares outstanding, which is 20 billion divided by 5 billion, which is $4. And so the PE ratio is just the company stock price, $100, divided by 4, which is just $25. So their PE ratio is $25. And if you were trying to calculate for the forward price to earnings ratio, it's just the same thing, except it would say forward 12 months EPS, and you would instead use the analyst estimates. So simple enough. And so now I want to talk about the last two types of PE ratio. And it's really only one more type of PE ratio because, as you'll see in this slide, the absolute price to earnings ratio is literally just the basic price to earnings ratio. It is just the current PE of a company at a certain point in time. And it takes into account the current price and the current earnings per share of that company. Uh, that's it. There's really nothing different. But the reason why I want to single this out is because it really helps explain the my last type of PE ratio, which is the relative price earnings ratio. So the relative PE compares the absolute or current PE, the basic PE, to the historic highs or lows of the company's PE. So it kind of compares the absolute PE um, to the highs and lows and uses the highs and lows of the PEs as kind of a benchmark for the current price to earnings to see, is this standard? Is the current price to earnings standard? Is it high? Is it low? Based on what the company has been at before. So it uses past trends to kind of evaluate the company's current price to earnings ratio. So you can see my example here. Let's say, for example, this is Apple or whatever, and it had a historic high of 100. So its P ratio at one time was 100. And then another point in time, there was a low, and its P ratio was 25. So let's just say, and it also uses time frames. So let's just say in 10 years, a high of 100 and a low of 25. And its current P ratio right now is 65. So it's very easy to calculate. It is just the current over what you're trying to compare it to. So you can see that the relative PE to the highest point that it's been in 10 years is 0.65 or 65%, which means that the current PE ratio is 65% below the highest point that the PE ratio has been in 10 years. And then you can compare it to the low. So you can see here that 65 divided by 25 is 2.6. So the current P ratio is 160% more than the lowest point at which the company has had its PE. So that's really the difference between the two. And so you may be asking yourself, okay, then what is a good price to earnings ratio? What makes a good opportunity? Well, I mean, it really is just up to you. You can see here that there's it depends on what you're looking for, I guess you could say. This graphic that I have here is good if you're trying to look for undervalued stocks that you may think could very quickly gain value because it may be overlooked by the market. But you can see that, I mean, but there's also a high PE may suggest that um, there's going to be higher earnings growth. And a low PE, like I said before, is just that it may be undervalued. And even though it's undervalued, it's still doing exceptionally well, which means that in time the price will increase. So that's really up to you. This is just kind of a recommendation, but by no means take this as absolute fact because everyone has their own comfortable spot. Everyone has their own uh, thoughts about what a good PE is. But anyways, that's about it for this video. I hope you understand what the price to earnings ratio is, how it is used in the markets, how it it is used to compare companies, how it is used to find good companies, to evaluate the overall health of a company. I hope you learned all that. So anyways, if you like this video, please leave a like. And if you like the videos that I have on my channel, then please subscribe. Anyways, that's all for today. Thanks. Bye.